Hello everyone, my name is Nathan Corroy and I'm here today with Dan Brown, our Director of Investment Management here at Richardson Capital Management. And we're here today for the Economic and Investment Update for the month of June 2023. Dan, as we reach the midpoint of the year here and look back on the first 6 months of the year, there have been a number of prominent issues kind of in the face of investors and hitting the financial press. We've had rampant inflation being much higher than the long run target. We've had increases in interest rates as the Federal Reserve tries to combat that inflation. We, of course, always have political issues hitting the headlines here in the US and geopolitical issues abroad. And despite all of that noise, we've actually had a fairly strong start to the year in the financial markets. Do you want to give a quick recap to kind of what we've seen so far and most recently this quarter?
Yeah, Nathan, that's a very good introduction, by the way. And somewhat surprisingly, in the face of all those kind of headwinds that you've described, as we sit the midpoint here, we wrapped up a pretty solid second quarter as far as the stock market is concerned, and that follows a fairly strong first quarter also. But if we dig deeper into the dynamics and what's actually happening in the market, it's kind of interesting because all the trends from last year are sort of the opposite as far as this year. So, for example, last year, most sectors were down. The best performing sector last year was energy. As we complete the first half of this year, energy is the worst performing sector. And then what's working this year is what didn't work last year. So last year, information technology as a sector was one of the worst performers. So far this year, first half of the year is the best performing sector. So kind of interesting. And then also what we see that we've talked about in the past is just a very narrow market leadership with a handful of large cap stocks kind of leading. And what we saw for the first 5 months is that a lot of other parts of the stock market didn't participate. And very recently, for example, we saw other parts of the market participate mainly in June. So for example, small and mid cap stocks started to work here in the month of June.
Got it. So we've seen pretty strong performance on the equity side recently. How about on fixed income? What are we seeing there?
Yeah, so just to recap the quarter, sort of a negative quarter here in the second quarter. And reason being is that we saw interest rates go a little bit higher over the course of the quarter. So interest rates go up, that means bond prices go down. And we saw the most interest rate sensitive part of the fixed income market, that being US Treasuries, post modest declines. And that followed a pretty decent first quarter. So all in all, a pretty decent first half of the year, with stocks definitely being in the leadership group, bonds still posting, solid, single-digit type returns.
As we talk about fixed income and interest rates, the big issue this year has been that the Federal Reserve increasing interest rates to try to tame inflation. In fact, we saw them do 10 consecutive interest rate hikes recently. However, at their most recent meeting in June, we actually saw the Fed take a pause and not increase rates further. You want to talk a little bit about what that's meant for the markets and kind of where we see that going from here, both here in the U.S. and globally?
Sure. So what we saw from the Federal Reserve and what we heard from the Federal Reserve after that June meeting is that Chairman Jerome Powell made it very clear that the Fed is going to continue to raise interest rates. In fact, he used language like, all members of the committee see at least one, probably two more interest rate hikes in store for the U.S. Federal Reserve. And he confirmed that later in the month at a conference of central bankers that met globally over in Europe. And again, very straightforward language about expect further interest rate increases from the Federal Reserve. And if we look at, compare and contrast that with other central bankers and what they were saying, kind of the same thing. So we saw from central banks of, European Central Bank, Bank of England, Bank of Canada, Bank of Australia, all were pretty adamant that they expect to continue to raise interest rates, all in the name of fighting inflation.
Right.
So I wouldn't underestimate, the language that they used. And it wouldn't surprise us if we saw further Fed interest rate increases at the July meeting and maybe September of a quarter point further.
So Dan, with all that in mind, what we've seen so far this year is fairly strong performance in the financial markets, but we're keenly aware of some headwinds kind of facing the markets as we go forward. What has that meant for the positioning of our client portfolios and where we see things going for the rest of the year?
So the positioning hasn't changed much the last couple of months, and if you've read the newsletters or watched these videos, you've noticed that we've expressed a fairly cautious outlook. Again, just a lot of odd cross currents going on with the economy, and we've never seen a cycle like this. So we still have that cautious approach, but that doesn't mean we don't own any stocks. It just means that we own less as a percentage than we owned, say, a year ago.
Right.
So all of our discretionary managed portfolios still retain a money market position because it's a risk-free asset that's yielding close to 5%, so a very attractive return in this environment. But still a little bit cautious. Again, it's an uncertain environment that we've never seen before, and we're going to continue to hold on to that for a while further.
Got it. Well, with that, we want to thank you for watching. Hope you found this video valuable, and by all means, feel free to share that with your family and friends or anybody that you think might find value in it.